Well, I hope you've enjoyed the discussion so far. We started off talking about the investment cycle, taking the core investment, making the critical purchases for the business, and then using those resources, of course, to operate the business. And then we started to move more and more into this accounting philosophy, this accounting approach. And it's important to walk slowly. So I started off going through some of the definitions and giving you definitions that ultimately will appear on the financial statements that we're about to talk about. But first, we need to understand what those items mean, which is why we talked about the definition. So in this section, we're going to discuss the differences between the various accounting statements. It is amazing to understand that financial statements provide critical insights for the business owner. They serve as a communication vehicle for the owner to share information. With who? With the investors, with the creditors, and with the shareholders. The term shareholder refers to the founder of the business, and if you should have stock, you're publicly traded, of course, the other owners of the business. Now, remember I used an earlier term called stakeholders. So stakeholder, shareholder, different. Stakeholder means anyone who is impacted by the business or participates in the business. So that's employees, of course, that's the founder, that's, of course, the creditors, the investors, the community. The shareholder is focused more on the management level, who owns the business. And the reason why we focus on financial reporting is that this information solely is going to the founder or to the business owner, chiefly for that person to use. However, there are going to be times when this information must be shared, and it must be shared with the creditor, with the investor. And this is typical for privately held companies. You don't have to share this information with the general public. You don't have to put it on CNN or CBS News. But the investor and the creditor may ask you for proof or evidence that your business is viable. And the financial record becomes that proof. The other reason why it becomes that proof is because the accounting profession has created some standards for creating these reports, making sure they follow a particular format. So everybody here in Chicago, everyone in the United States, everyone around the world is comfortable with this format. And they know when they look at a particular report that's entitled with a certain name, they know exactly what to expect on that report. And they can then quickly just go in and assess the numbers to see how well the business is doing. So it is a communication tool, or I should say they are communication tools when we talk about the reports that we're about to reveal in a few minutes. So let's talk about them. Financial statements identify financial measures that show the owner what normal business operations look like. While this is the third bullet, it's actually, I would say, one of the most important bullets. What it means is very simply that in most cases, business owners, if asked how the business is performing, will say the business is fine. But in many cases, they really are not sure. If you start to track what is going on with the business financially by using these reports in the future, what will happen is that you may be able to see seasonality appearing in your business. So for instance, maybe your sales are stronger in the summer and they just normally decline in the fall. Rather than in the past panicking because sales are looking lower in September and October than they did in June and July, you just know that historically that's what happens. We have strong sales during the summer and then they start to lower and flatten out in the fall. As long as you see that similar pattern, you won't panic. So again, having these resources, such as financial reports, it helps you to become better at tracking and understanding what the normal business performance looks like. Item 4, financial statements help you to highlight trends that indicate trouble is approaching. If you're tracking your financials during the year, and let's say we're in the month of September, and you go back in time and you look from January up to September, you may see a pattern. You may see that costs are starting to rise unexpectedly. That's going to trigger in your mind, I need to investigate. I need to research what is going on here and hopefully find out why those costs are increasing and then make the appropriate adjustments long before we get to the end of the year and find out that our profitability has suffered because we didn't track or we didn't catch that our costs were rising unexpectedly. Financial statements helps the founder to better understand the limits of their chosen business model. We introduced that concept of business model earlier. What does that mean? It means sometimes I may choose an approach to running my business. Let's say I started off my startup using a subscription model where I have people paying me each month, and they're paying a single payment each month, same amount all the time. And you see this with health clubs. Let's say for some reason my cost has all of a sudden skyrocketed. My landlord has hit me with an increase that I wasn't expecting. Let's say as we're going through this post-COVID period, my other operating expenses have risen more than I expected. Well, my problem is I have everybody on a subscription, and therefore I'm always receiving the same dollar amount all the time. It may be that that dollar amount is no longer adequate to pay the rising costs. I now have a situation. I may have to change my business model. And that's what that last statement is talking about. So these are the 5 reasons or benefits that financial statements give or allow the business owner to use to become better at doing what they do. So let's take a look at the 3 statements that we're going to be talking about. One is called the income statement. The next one is called the balance sheet. The next one is called the cash flow statement. These documents are used to record the use and source of cash available to the business. Typically, there are 3 sources of funds for a business. The first is revenues. The second represents monies collected from bank loans. The third, monies received from investors or generated by the business itself in the form of profitability. These records are also valuable because the owner can identify financial measures that show the owner what normal business operations look like. This note is invaluable. In many cases, business owners are not sure how the business will respond to unexpected changes in market conditions, such as declining customer demand, rising interest rates, or a period of rising operating costs. These documents can serve as an early warning signal to indicate trouble is approaching. Lastly, they help the founder to better understand the limits of their chosen model, as we mentioned before. And it prepares them to be able to look at their business in a more informative way as they plan for future growth, as they plan for future expansion of services, or in this case, goods. To gain the most from these statements, we must be able to understand how these statements are constructed. We're going to take the time now in this segment to walk through each of the 3 financial reports in detail so you understand what's in them, how they're structured, and why they're important to you and your business. We start off with the income statement. There's 3 pieces to the pie. First, revenues. Second, operating expenses. Third, what we call profit, loss, or break even. So let's start with revenues. As I mentioned earlier, revenues always appear at the top of your income statement, never in the middle, never the bottom. So whatever revenues you generate in a given period, either quarterly revenues, annual revenues, the number will appear at the top of the income statement. In the middle of the income statement, we're going to see operating expenses. And at the bottom, we'll either see a profit or a loss. Let's see what that looks like in practice. As we see at the top, revenues appear at the top, measuring about $30,600. In the middle, we see operating expenses. Typical operating expenses, selling and administrative expenses, interest expense, maybe on a loan, other operating expenses, which can include lease payments. Those are captured in the middle. And at the bottom, we see what we call net income or loss. The phrase net income is a common phrase used. It can be used interchangeably with profit. Both of them mean the same thing. What we need to know here is that your income statement should only show these 3 items. It should only show revenue, it should only show operating expenses, and it should only show a profit. Now, how is profit calculated? Profit is calculated based on an equation, and that is revenues minus expenses equals profit only if your revenues are higher than your expenses. So revenues minus expenses will equal profit only if the revenues are higher than your expenses. As we see in this example, the revenues turn out to be $30,601. When we look at the total operating expenses, they're $9,862. Clearly, the operating expenses are less than the revenues. More than likely, we are going to earn a profit after tax. So your income statement is only going to show the revenues, it's going to show your operating expenses, and it's going to show whether or not you generate a profit. Now, what if you don't generate a profit? What happens if your revenues are less than your expenses? Your income statement is then going to show what we call a financial loss. It has meaning. What that means is that your business could not generate enough money to pay all of its expenses. It means that the expenses were paid. The question we must ask is how? More than likely, what has happened is that the owner has had to go into their pocket to make up the difference. The reality is the owner can't continue to do that forever. Eventually, the owner will run out of money and may have to go to family, friends, or maybe some other outside funding. But even eventually, that will run out. So if you generate an operational loss, a financial loss, you must keep in mind the clock will start ticking, and there's going to be a limited amount of time you're going to be able to turn that loss around and turn it into profit. The last option that can happen is that your revenues are equal to your expenses, and we call that break even. Not an ideal situation in the sense that you generate a profit, but it is okay because it means that you paid all your expenses. So from a business owner's perspective, if I'm looking at my income statement, if I see a positive number at the bottom, which means I made a profit, or if it's a zero, it means at least I've paid what I owe and the business is okay. If I see a loss there, then guess what? I'm going to have to consider finding monies to cover those losses, keeping in mind that there will be a limit to how long I can do that. Our next report is called the balance sheet. The balance sheet typically has several items on there. You see cash, accounts receivable, inventory, physical property, and then that last item is called ideas. So a typical balance sheet, in this case, since we see inventory on it, this is a typical balance sheet for a retailer. If this was a service company, such as an accounting firm, a law firm, we wouldn't see inventory on there. We may see accounts receivable, we may have some physical property, we may have this section called ideas. Ideas means copyrights, trademarks. Those are also valuable to a business. So the point of the balance sheet shows us what we call critical stored value. It shows us our assets, and it shows us where our assets are in terms of where we've been spending our money. Is most of our assets in the bank, meaning it's a bank account? Is it being spent on inventory? Is it tied up in accounts receivable? Is it tied up in some physical property? So the balance sheet is really showing us the makeup of our assets. It also will show us our liabilities and equity as well. So as we mentioned earlier, the assets represent the resources that the business either owns or controls. Here's what a balance sheet looks like in a traditional sense. Always to the left, you have your assets. The assets are split by what we call current assets. Those are your short-term assets, and we mentioned these are items that are used within a year. Then we have your long-term assets are always at the bottom. These are the items that are used for a period greater than a year. On the right-hand side, always on the right-hand side, you'll have your liabilities and you have your equity. Remember that accounting equation. Your total assets are equal to the sum total of your total liabilities plus your equity. The right-hand side is telling the world how you paid for the assets. Your job as a business owner is balancing that. You want to make sure you don't have too many liabilities so it becomes unbearable for you to afford. You can't pay the principal payments and the interest payments. But at the same time, you do want to use credit whenever possible to sort of stretch your investment dollars that you've put into the business where appropriate. So the balance sheet is helping you as a business owner understand that balance. That's why it's called a balance sheet. Understanding when I need to use liabilities or when I can use liabilities or debt, and when I need to bring in investors and bring in investor capital. So as I mentioned, on the balance sheet, you're also showing liabilities. This slide here shows you the breakdown of the liabilities. The liabilities are also split between short-term and long-term. So typical short-term liability would be an accounts payable, money that you owe to a Office Depot maybe, or maybe money you owe to FedEx Kinkles for copies that you made. Maybe also wage payables. I have employees and I have to pay them once every 2 weeks. And maybe I'm using a service like ADP to handle my payroll for me. That will also be considered what we call a short-term liability. I could also have a short-term loan, monies that I have to pay back within a year, maybe pay in 3 months, maybe pay in 6 months. These are typically what we call lines of credit. So that would also appear. Then I will have, as we mentioned, long-term liabilities. Those typically are mortgages or other debts that the bank may give me. They may give me a 2-year loan or a 3-year loan. Short-term loans typically are going to be given to you by the banks. On the other side, where we're talking about short-term loans, those are going to be loans coming from our suppliers. Basically, our suppliers like Office Depot, FedEx, Kinkos, giving us some line of credit so we can make the purchases we need for the business. What you see there at the bottom, you see that accounting equation. Assets equal to liabilities plus equity. It's just reminding you that that equation exists. It shows up in the balance sheet, telling you your assets must be equal to your liabilities plus equity. So when we think about equity, and I just want to spend just a few minutes on it, as you see, there's 2 pieces of the pie here. The right side, startup capital. That is your contribution as an owner. When you started up the business, you bring in some dollars to start the business. That is always recorded on your financial records. It's your evidence that you contributed to the business to get the business off the ground. Then the retained earnings reflects your history as a manager of your business. What we're looking for here, or what the creditors and investors are looking for, is that you're making appropriate management decisions that are essentially making sure that your business is profitable. And over time, we're going to add up those profits that you've earned each and every year. That sum total is considered your retained earnings. It's reflecting the fact that you've been contributing money back to the business. And you've been doing that through the profits that you've been able to generate as the leader, as a founder of that business. Retained earnings is calculated by adding the profit or loss for each year since the business has been in operation. We close this out by just showing you a quick calculation. So we look at the balance sheet report, same one that we were just looking at. We look on one side, the left-hand side, we have our total assets totaling $21,600. Our liabilities total $88.93 or $8,893. Our equity totals $12,707. We add liabilities to equity, it turns out to be $21,600, which equals the amount on the asset side. Your balance sheet should always be balanced. If someone gives you a balance sheet and the numbers do not add up, the total assets do not equal to the sum total of liabilities and equity, there's an error. And you do not want to turn those statements in to anyone. You don't want to turn them into the bank. You don't want to turn them into the IRS. It's going to raise a red flag. You need to find out where that error is, what's causing that error, and you need to fix it. The cash flow statement is the last of the 3 reports. The first one, income statement. The second, balance sheet. The third, the cash flow statement report. This one is a very unique one. Most people don't even look at it. Most people don't even talk about it. But literally, what we're talking about in this report is where's your money, where's your cash coming in from to your business, and where is your cash going? Most people think, oh, Adam, I know what you're talking about. The cash is coming in from my revenues, and the money is leaving through expenses. That is true, but that's not the only, revenues in this case, are not the only source of cash, and expenses are not the only use of money. So your cash flow statement or cash flow report is giving you an accounting of where your money is coming in from, all the sources, and where you're spending money, all the outlays. So what are the three sources of monies coming in? One is coming in from revenues. Second is money coming in through a loan from creditors. The third is money coming in from investors. So those are the three principal sources of money coming into a business. Where is money leaving the business? That is money going out as expenses, your operating expenses. That's number one. Money leaving the business is also for repaying your debt, paying your principal and interest back to the bank. The third is that the investor, the founder, and investor may want to pull money out of the business. We call that a withdrawal. And they may want to use that money for personal use. You have three sources: revenues, loans from a bank, investment dollars. You have three uses of funds, or three uses of cash: paying my operating expenses, paying back the bank, paying money to the investor or to the founder. And your cash flow report is giving you an idea is where the cash is coming in and how it is leaving. You're looking for most of your cash, ideally, to be coming from what they call operating activities, which essentially means that the business is working, is generating enough money to literally pay for itself, to be self-funded. And oh, by the way, I'm using some supplemental cash coming in from investors and creditors to even enhance the business and do even more with it. So that cash flow statement is really the final statement that's letting you know how your cash is being used in the business, and then you, as the owner or founder, can make the choice or make the decision that the money is being used appropriately for the business that you're in, and also for the goals that you set for the business. I'm trying to scale the business, I'm trying to grow the business, and I'm generating enough money to do that. I'm trying to stabilize the business, trying to reduce my cost, and guess what? I get to see that in the cash flow statement. So those are your three statements. The first one, income statement. It only shows revenues, operating expenses, profit, loss, or break even. The next one, balance sheet, only shows assets, liabilities, equity. The cash flow statement shows you sources of cash coming in and uses of cash going out. That completes our review of the three principal financial reports that you will use as a business owner to run your business more efficiently and more effectively.